previously considered a tick and flick exercise when the annual premium rolled around, are now going to be examined and explored with caution in this post-COVID era. So insurance used to be all about the pricing and managing premium costs. But now the question is, can I get the type of insurance that I want? And what do I do if I can't? So some insurances might not be provided, some could be limited, and some industries might find it harder than others to get insurance. In our discussion paper from earlier this year, we indicated foreseeable changes with workers' compensation insurance, business-related travel insurance, but no doubt other types of insurance such as public liability insurance will also be impacted. And it might not just be COVID that's impacting changes in our insurance arrangements. So the coal industry has recently indicated they may be moving to a self-insurance model as both insurers and investors move away from coal projects due to concerns about global warming. And in recent times, we've also seen natural disasters such as bushfires and floods resulting in insurance impacts. So lots to talk about when we think about insurance-related risk for businesses. So Chris, thank you very much for coming today and agreeing to talk with us, and I'll hand over to you now.
Fantastic. Thanks, Bron and James, for the introduction. Very, very kind. And I think, what we've seen in the insurance market, particularly over the last 6 to 12 months, has been really interesting and really challenging for businesses over and above the challenges that a lot of businesses are facing with COVID. So today is a lot about giving you some insights that some that you may have heard before, some that you may have experienced firsthand, and some that may be new to you. So we wanted to give you a bit of an overview of the global insurance market and some trends that we've seen over the last little period, focusing in on the Pacific region after that, and talking a little bit about some of the trends that we're seeing here locally, talk a little bit about market cycles and where to from here and what the future looks like. As James and Bronwyn mentioned, also looking at what businesses are doing to look at alternative ways and means for risk transfer and risk financing. And then lastly, we'll talk a little bit about what you can do, some key strategies and actionable steps that you can take in dealing with your insurance program ahead of your next renewal, or if you're through a renewal cycle, how you can deal with your insurance broker and insurance company to get a better outcome through the insurance process as well. Bron and James, do you want me to share the presentation, or
yeah, I think that'd be good.
You.
Yeah, you should be enabled now, Chris. So yeah, you're good to go, mate.
Bear with me 1 second. Let me just get the presentation back up. Okay, hopefully this works. Okay,
good to go.
Good to go. Fantastic.
All good.
Let me just scroll back up to the top. Okay. Perfect. So, as I mentioned, the insurance market's changed, and as Bronwyn said, that going back 4 or 5 years, it became about price. It was all about shopping for the best deal and being able to go into the market and obtain price decreases or increases in cover were very easy, and we saw a material shift in the way that insurance brokers and insurance carriers were dealing with insureds 5 or 6 years ago, and unfortunately all good things must come to an end, and what we've seen since that period has been a great deal of change, which has made it really challenging to get better deals in the insurance market. So if we have a look at where things are in terms of global trends, the data on this slide is all from the Marsh pricing index, which has recently been updated as well. So what I can update you on, so global commercial insurance prices rose 15% in the second quarter of 21. So it's now the 15th consecutive quarter of global insurance price increases. This was largely driven by increases in the UK, which had a composite pricing increase of 28%, as well as locally here in the Pacific region, we had the second highest composite pricing increase of 23%. So a lot of the global pricing driven locally here out of the Pacific region. Thankfully, it does appear as though, barring any unforeseen changes or any unforeseen circumstances, that the pricing, insurance pricing, did increase. Has peaked in the fourth quarter of 2020 at 22%. So, as you can see, it's now starting to trend downward, and those pricing increases are being moderated. In the second quarter of 2021, as I mentioned, the Pacific region increased 23%. So that's continued the upward trend that we've seen really since 2015. If we drill into some market-specific areas, so property insurance locally increased by 14%. That is a moderation in price increases from what we've seen in the 10 prior quarters. So while we have seen rates continue to increase, this has been lower more recently. So this has been driven by some competition which has returned to the market, but this has largely been for quality loss-free clients. So again, if you can demonstrate a good approach to risk management and a good approach to claims and limited claims on your portfolio, there is some capacity coming back into that property market. However, there are still challenges that remain for high hazard industries. So unfortunately, mining's not excluded from that. And we've seen some high profile components as well. And Bronwyn alluded to some environmental impacts as well. And we've seen that, with Adani, the difficulty in being able to get insurers to participate in programs like that has been evident. In addition, also risks in catastrophic zones. So far north Queensland continues to be a big problem for organisations, as well as clients with poor loss records or poor risk management approaches as well. If we look at casualty, so primarily driven by public liability, casualty prices increased by 18% in the most recent quarter. That's actually the largest year-over-year increase that we've seen since 2012. So there's a really strong emphasis in the casualty market around policy wording and policy wording reviews. So I strongly encourage you to have a look at your policy wordings and see if there's been any changes or pressure come under policy wordings from insurers. So a number of major programs did undergo some substantial restructuring of some of their excess layers. Underwriter appetite to write particular excess layers has really shifted in that casualty market. And we're seeing a lot of pressure in the casualty space. And then thirdly, financial lines. So here we're looking largely at D&O, professional indemnity and cyber premiums. So locally, in the most recent quarter, we had financial professional lines pricing increased by 37%. This is a moderation still from the 48% you can see in the graph that we've referred to in that slide, but it now does make 16 consecutive quarters of double-digit increase in financial lines. So we are seeing D&O liability pricing that is leveling out. We are seeing some excess layer capacity re-enter the market, which gives us some hope in that D&O space, which has been really difficult. And I'm sure everyone in the room has experienced some D&O pricing difficulty in the market. Professional indemnity premiums have continued to increase. We are seeing a tightening of capacity in the professional indemnity space. So that is something to be mindful of, that if your business is reliant on professional indemnity, that we are still seeing challenges in that. And cyber premiums, again, increasing significantly. While we have seen some significant local increases, that is in line with global trends. We've had some large ransomware claims that have come through, and that's really impacting cyber premiums. So if you are buying cyber insurance, that is going to continue to be a challenge. I wanted to talk a little bit about the insurance market cycle. So what we're seeing now has transitioned from a hardening market into a hard market. So what we saw in sort of 2019, low interest rates started to undermine insurer profitability. So we end up on the right-hand side of that graph there. So capital flows into the market and rates started to fall. So premiums need to rise to meet insurer investment return demands. In addition, the insurance industry suffered a number of large losses, both here locally in Australia as well as globally. We saw a number of large fire events, followed by flood events here in New South Wales as well this year as well. So we have seen some natural catastrophe events locally, which has impacted pricing. When you put on top of that the COVID-19 pandemic, which has impacted what was already a fragile economy, we really have a recipe for disaster here. So insurer capacity has completely eroded. So we now have an imbalance between supply and demand. The demand for insurance from businesses is just not being met with capacity in the insurance market. So to combat that, insurers have simply become selective of risks and industry that are appetizing for themselves to underwrite. So we're undoubtedly in a hard market. So we can see in that insurance market cycle, we're sort of in that bottom left-hand quadrant of that, where risk selection rejects some activities and industries, and rates have risen strongly. So the good news for us is that we are now, we believe the worst has happened, and the rate increases are now starting to moderate. So we're hopeful of being able to transition into a seller's market and ensure profits return to where they need to be, which will then help capital flow into the insurance market, which will increase capacity and start to bring rates down again. So that's where we're at in terms of insurance market cycles. So any pain that you're experiencing is there is some light at the end of the tunnel for us. What we're seeing now as a result of these price increases is disruptors are emerging. So there are a number of players that have entered the market to try and provide affordable solutions for consumers, particularly in alternative risk transfer markets. So what we've seen is some industry-focused organisations come into the market. So if you look at things like Upcover, Upshore, Hustle, these organisations are primarily looking at addressing insurance demand issues in things like the Uber Eats delivery market, last mile delivery, contractors, remote workforce, so sole traders, that type of thing. So looking at the gig economy, we have seen new entrants come in to try and meet insurance needs for participants of the gig economy. You look at somebody like cyber indemnity solutions that have come into the market as well to support organizations with better managing or being able to provide cyber insurance, which is a big risk and one that's often ignored until it hits and until you're dealing with a large hack or ransomware or cyber attack that's impacted your business. And then we've seen a lot of change in the life insurance market and new entrants into this market like Integrity Life, which have come in through acquisitive growth here in Australia and are looking to address some of the challenges in the life insurance market that has seen a hardening or hard market for a number of years before the commercial insurance space in the general insurance market. In the middle, we've got some mutual funds. So this is a little bit of a back to the future approach here with the mutual funds. So organizations like Picnic have entered the market to provide access for organizations connected by affinity or mutuality to be able to pool their risk and exit the general insurance market to be able to look after themselves and then buy insurance at much higher levels through the reinsurance market. Our ARC is a great example of that with the Anglican Diocese in Far North Queensland to address the issues that they're facing up in Far North Queensland in being able to get insurance cover, particularly for things like property risks that are exposed to natural catastrophes. Our ARC has been a great solution that was started by the Anglican Diocese up there and is now open to like-minded organisations in Far North Queensland to be able to address insurance capacity issues in that region. And lastly, something like Extras Jar is a really interesting concept. So Extras Jar have come into the market and looking at using a discretionary mutual fund to revolutionise the way that we buy private health insurance extras. So there are organisations that are coming in to fill the gaps left by traditional insurance markets due to the capacity and pricing issues that we're experiencing. And then lastly, alternative risk transfer. So we're seeing significant growth in the captive insurance company and renter captive space. So organisations that are large enough to explore their own captive insurance companies are doing so. And we're seeing a lot of demand at the moment for captive insurance feasibility studies, whether it's looking at your own captive insurance company or looking at entering a single cell captive in somebody else's captive insurance company. Both are really interesting options for organisations that are outside the traditional insurance market, as well as some alternative insurance structures. So things like high deductible insurance renewal strategies, or deductible corridors, self-insurance for particular risks. We're seeing a much greater appetite for organisations to go down the alternative risk transfer routes rather than dealing with conventional insurance markets. And then lastly, I wanted to just talk a little bit about how you can impact your next insurance renewal. So if you do have to deal with the insurance market, what's the best way to go about doing that? So I've included here 5 key steps or things for you to consider. So firstly, early preparation is critical to a positive outcome. And I can't stress this enough, that insurance renewal processes should start at least 3 months out from your policy expiry. So often what we see, and too often we see insurance brokers coming to organisations 6 weeks out, 4 weeks out, sending you a renewal questionnaire, asking you to complete it, and then entering the insurance market with 3 or 4 weeks to go. That really limits their capacity to be able to buy insurance on your behalf and get the deals that you're looking for. So starting early, having a strategy meeting 3 months out with your insurance broker, agreeing a renewal timeline, understanding information requirements, and then developing a clear marketing strategy to address the market is really critical to getting a good outcome from the insurance industry at the moment. Secondly, presenting detailed risk information to insurers and working with organisations like Mindful Risk in terms of developing your enterprise risk framework and understanding what risks you can self-insure or take on versus what risks you need to transfer into the insurance market is critical. So this is a great opportunity. The annual insurance renewal is a great opportunity for you to speak to your insurance broker and tell them all the wonderful things you've been doing across enterprise risk and occupational health and safety. Selling your risk into the market is more important now than it's ever been. So I really encourage everybody to go beyond your insurance broker's standard renewal template. That's a start point and definitely shouldn't be limited to what you do. Showcase your risk, because if you can differentiate your risk and demonstrate to the insurance market that you are a good risk, there are good outcomes to be had in the insurance market and better than average outcomes that can be achieved there. The third point was about regularly testing the insurance market for a better deal. So make sure that you do regularly go to the insurance market, understand what insurance options are out there. As I said, there are disruptors that are coming into the market. There are alternatives both here locally and then in other parts of the world that haven't been quite as impacted. You look at parts of Asia that haven't had the same pricing pressure that we've had here in the Pacific. Similarly in the US. So understand new offerings, develop relationships with the insurance across the industry and understand what options do exist for you outside your incumbent insurers on your program. The fourth component was about analysing the accuracy of insured values and limits. This is incredibly important as well. Insurable risk profiling and risk tolerance assessments are great tools to be able to do this. As well as insurance valuation, whether it's a business interruption valuation or property valuations, to avoid things like co-insurance clauses on your policies is essential to making sure that your insurance policy is set up to react in the way that you intend it to in the event that you need it. So conduct modeling to analyze business risk scenarios that underpin your policy limit decisions. Don't be guided by standard limits. Just because your PI policy has a limit of 1 mil or 2 mil or 5 mil, or just because your liability policy has a limit of $20 million with a $10,000 deductible, don't use those default settings as the basis for your insurance buying decisions. Understand what your business needs, understand what your appetite for risk is, and buy insurance to meet your needs, not don't be dictated to by insurer defaults. Also, any assumptions that insurers make on your behalf with regard to your insured value or your limits will be filled by premium. So it's really important that we don't leave anything to assumptions for insurers, because that's a really easy way for them to increase your premiums on you. And then the last point was ensure your broker is representing your business accurately. So when they do go in the market, make sure they understand what you're doing. Make sure they understand your business activities, any changes to your business over the last 12 months. they need to be selling your risk into the market. So the last thing you want is a transactional relationship with your broker. You want it to be filled with open communication, and have them have a strong understanding of your business to make sure that there aren't any last minute surprises, and that they are giving you updates throughout the insurance process. When it comes to your insurance broker as well, there are some really sort of simple things that you can do through the insurance period as well, and outside of the renewal cycle, just to make sure that you're getting the most out of your insurance broker. So one, make sure when they invoice you, it's finalized quickly and accurately. Insurance companies and insurance brokers often make mistakes on their invoices. So just double check premiums, taxes, charges, make sure that there are no surprises, because you'd be surprised how often they get it wrong. Ensure the policy documentation is delivered on time and checked for accuracy. Again, you would be surprised how often they get this wrong. The other thing as well is when the broker sends your invoice, they will often attach a coverage summary to your invoice. That's not your insurance policy. So make sure that you do receive formal policy documentation. That's often provided after your invoice has been paid, and it'll come on your insurer's letterhead, generally with a stamp and a signature. So make sure you're getting that, and that's being reviewed so that there are no errors in that, and it's set up in the way that you intended to through the renewal process. Another really simple thing, make sure that your insurance broker provides you with an insurance manual. So the insurance manual should provide a consolidated summary of all your insurance policies. It'll also have key broker and insurer contacts, as well as a guide to making claims, which is really, really critical. You need to have that within a month or two of renewal. If you haven't received it, don't be afraid to ask. It's something that gets overlooked, but it's a great one-stop shop for all of your insurance needs, basically. Shouldn't dictate terms of your strong service level. Make sure you've got guys in there, and then make sure your broker adheres to the KPIs and the service level agreement. It also encourages better dialogue. It encourages a better partnership and relationship with your broker, and avoids that transactional nature that we often see, where your broker only sort of comes to you at renewal time or in a claim.
Oh, Chris, you just glitched there for a second. So I was going to say you might need to just loop back over that last couple of sentences.
Oh, sorry, guys. I think my internet just glitched a little bit. I was just saying, James, thanks for that. I was just saying, make sure with the broker that you've got the service level agreement, that there are KPIs in the service level agreements, and that really encourages a better relationship with your broker, which is more partnership based than transactional at that renewal time. Second last point that I wanted to make was agree written claims protocols. That'll be included in your insurance manual, but ensuring that there are claims protocols on each policy prior to a claim occurring means that when a claim does occur, you've got a process in place that's been agreed with you and your broker about how claims will be managed, so that you're not trying to make things up on the fly. And then the last thing is, if you haven't, make sure you review your insurance broking arrangements. There are a lot of alternatives in the market. There are more and more alternatives coming into the market. If you look at the mining space specifically, as I know there are a lot of you in the room do come from that industry, you look at things like CKA, which was very strong in the mining space in Perth, was acquired by Gallagher, and then those same individuals have recently left and started Fenchurch Insurance Broking, who are very strong in that world, as a Lockton and other providers. From a global insurer space or insurance broker space, we've seen Howden enter the market here in Australia as well. So as well as some acquisitions, obviously JLT was acquired by Marsh. Aon made a $46 billion bid for Willis, which recently fell through about 3 or 4 weeks ago too. So there is a lot of change in that insurance broker market. So it's good to understand what your service fee is, what your broking fee is, where your broker is earning money, and make sure that you are getting the best deal from your insurance broker as well as your insurers when you're dealing with them in the market. So in the 20 minutes that James and Bronwyn have given me, that's our sort of little round the world trip in the insurance space, and hopefully it gives you some guidance and some help as to what you might be experiencing in the market and how to get a better deal from your broker and your insurance companies on your policy.
It's actually 15 minutes, Chris. You've gone 5 minutes over.
Oh no.
No, not at all. Not at all. No, look, that was excellent, Chris. And I've got a ton of notes. And it was certainly, there's a lot of technical aspects to it. And I'm sure there'll be plenty of questions from the floor that will come. But yeah, thank you very much for a fantastic presentation. Certainly taught me a lot, and I'm sure it taught Bron and many of us in the room plenty of things that we need to go back to our personal brokers for our own businesses, or to go and assist our clients with more generally as well. But look, there are a couple of quick things I wanted to throw out, and then we'll go to open questions because we do have another 15 minutes up our sleeve. I've given what you mentioned around these alternate insurance vessels. I'm really interested to know a little bit more about this, like Picnic and this white labeling model, because I know a number of organisations we've worked with have looked at this, and obviously BG in the mining space, knowing that the coal sector is looking at these types of things. I'd love to know a little bit more about that, because as much as I'm aware, Picnic's almost like a white labelled self-insurance service. Is that how I'm understanding it? So I just wondered if you could just explain that a bit more before we throw to open.
Yeah, exactly. It's Picnic are a very young insure tech company, basically, that have entered the market to largely drive solutions around appetite for onshore captives more than anything. So the captive market in Australia has been difficult because of two things: regulation and taxes. So often what we see is organisations that are looking around the captive self-insurance space is that they go to offshore markets and low tax havens. So Bermuda is the number one jurisdiction, as you can imagine, for captive insurance companies globally. So we have seen, there are a number of others. There are some states in the United States, as well as places like Singapore, Cayman Islands. So there are a lot of organisations that do operate captive insurance companies offshore. Picnic's come to use existing models in Australia to be able to achieve the same thing. So if you look at our ARC and what they've done with the Anglican diocese up there, a discretionary mutual fund is an insurance-like concept. So with an insurance policy, you're receiving an indemnity. So you are receiving, there is a contract that says, if this happens, you will receive this. So there is a promise, or a contractual promise through an insurance contract. Under a discretionary mutual fund, that promise is actually not an indemnity. It's a promise to consider a claim that is made. So it's a nuanced difference to insurance, but can be housed here in Australia. It's not ASIC regulated, so it's not an ASIC managed insurance company. It is APRA. Sorry, other way around. It's an ASIC regulated. It's regulated by the Corporations Act, not APRA licensed insurer. So it does operate here locally, and what will happen is you become a member of the discretionary mutual fund. It has a similar, it looks and feels like insurance, but the key aspect is that discretion. So when it goes to the trustee of the fund, you might go and say, I've got a property claim for $1 million. Maybe that doesn't quite fit exactly, and an traditional insurance company may decline that claim or review it. The trustee can agree, they can pay the $1 million, or they can say, you know what, you're underinsured, we can pay 1.2, we can pay 800. There's a much more open relationship or engagement through that discretionary mutual fund. But it isn't an insurance policy. So it's not for everybody, but it is a really interesting solution. And we're working with Picnic on a few different things through the InsureCo as well to build some alternative insurance options for organisations out there. But our ARC is a great, gives you a great sort of start point for understanding what you can do through onshore discretionary mutual funds as an alternative to offshore captive insurance companies.
Great. Thanks, Chris. Thanks. I think Bron, one came in from Kath, didn't it, as well?
Yeah. So thanks, Kath. So Chris, I've got a question, but I'll throw to Kath first, and hers is with regard to COVID. will there be reductions for organisations that have got their employee bases fully vaccinated and probably have processes, I would imagine, in place for their contractors coming on site as well?
Yeah, I think having a COVID risk management policy is really, really important. I'm spending, as everyone can imagine, I think I probably spend 95% of my day right now talking about COVID and the impact of COVID on organisations. So it's good.
COVID.
It's a real, and it's a really interesting space right now. And right now, a lot of the focus is what do you do with your workforce, and particularly individuals or employees that you may have that are vaccine hesitant or won't go and get the vaccine. So that's something that we're dealing with right now is how do we manage that? How do we manage your employees or contractors, particularly in areas or industries where that's vital right now? So you look at construction, healthcare, particularly, two that have impacted straight away, but we expect that to flow into other areas. So I think to answer your question, Kath, it's too early to tell, but I think that the organisations that have a really robust approach to COVID risk management, both through your employees, contractors, and members of the public that you may come in contact with, will undoubtedly get better outcomes than those from the insurance market than those that don't. And I think this comes back into the point of selling your risk and representing that you're a good risk. And we've spoken a bit about that today, that COVID and COVID risk management is just a natural extension of that. So I think while it's too early to tell whether there'll be discounts or incentives for organisations that that are more COVID compliant or have better COVID risk management protocols in place, I think we can definitely say that you'll be looked favourably upon if you do.
Thank you.
So look, my question, and then we'll open up to the floor. So I just wanted to check in on supply chain related insurance arrangements, Chris, and if you've got any insights there, because we're starting to see escalation of issues and risks associated with supply chain and that disruption to service. So do you have some insights in relation to how businesses are responding and insurers are responding to that?
Yeah, that's a very good and a very tough Dorothy Dix question. Brian, you said you were going to be kind when asking questions. That is a very good one. So business interruption is a very interesting space right now, and we've seen some COVID test cases around business interruption as well. I think. Supply chain risk management.
Chris, didn't the latest one go in the favour of insurers? I thought the most recent one went back in the favour of the insurance market. Yeah, okay.
Exactly. Yeah. So I think when you're looking at BI, supply chain, that sort of thing, I think it's COVID, and there's been a few things. COVID has definitely exposed that, as well as what we saw in the transport and logistics thing, with a particular ship blocking a particular canal, caused major disruption to services. We've seen issues in China with
he was just doing
delays.
A 3-point turn, wasn't he?
It's just a little exactly
a little 3-point turn they didn't quite master.
Exactly right. We've seen issues in China getting things in and out, and significant delays in ports in particular parts of China as well, which has caused issues. And then we've seen particular, components and manufacturing. You look at things like computers and monitors and any electrical goods right now. You can't go on Microsoft and buy one of their new laptops anymore. There is no product at all in Australia to be able to do this. So I think supply chain risk and insurance to be able to support that has come under incredible pressure in the last 12 months. So I think that we'll see continued challenges in terms of doing that. But again, I think understanding supply chain risk and doing your best to be able to manage that and then representing that in the insurance market will give you the best chance of being able to get a good outcome. But it's a really good question and a very, very timely one given what we've seen over the last 12 to 18 months.
Thank you.
Excellent.
So I'll just throw to the floor and
yeah.
see if there's any questions from anyone in our group today.
I've got one on the captive insurance companies for Chris. Chris, firstly, are there companies or consultants, etc., out there that help companies create their own internal insurance products? I'm guessing so. And then the second question was, if a company sets up their own insurance and they've got a large customer base in a sector and it's for a specific type of insurance, can they actually not only insure themselves but actually create their own product for their customer base?
So yeah, the answer is yes to both of those things. In terms of the captive insurance company, absolutely. So there are plenty of organisations out there, and that's something that we do. We support organisations to be able to do captive insurance company feasibility studies. So, and as I mentioned, we're seeing an increasing trend of organisations looking to do that and understanding the viability of a captive insurance company, whether that's going sort of whole hog and setting up your own captive insurance company, or whether it's going, dipping your toe in the water because maybe you're not big enough or you don't have the appetite to do so, is that you can rent a single cell in somebody else's captive insurance company too. So there are some options for organisations to do that, and it is for organisations that do have their own captive insurance company to be able to rent out a cell helps them de-risk their own captive as well as find alternative sources of revenue effectively to be able to support their own. So there is some appetite for organisations that do have their own to be able to rent out single cells in terms of doing that. So to answer your first point, yes, definitely. And we're seeing a lot of activity in that captive insurance feasibility space. To answer your second point, again, yes. I look at our own business, we're supporting, I think, 3 different initiatives at the moment for different things. One of them is a warranty product. Another really interesting one is trades and contractors insurance, and we're exploring that for an organisation to be able to allow them to get their trades and contractors insured through a white labelled insurance product. So that instead of going to the market and buying, tradie packs, PIPL, plant equipment, motor, that sort of thing, being able to build our own that's for the specific needs of the principal contractor here to look after their trades base. So, they're a very significant organisation. They've got 40-something thousand contractors, so it makes a great deal of sense for them to be able to do that. Not only does it provide their trades and contractors with a better deal because they get a bespoke policy that's priced accordingly. Again, it can be an alternative revenue stream or a point of difference for the principal contractor in doing that as well. So the answer again is absolutely. If there are particular markets or segments that you'd like to consider carving out, there are definitely models available to do that. And as I said, we've seen, upcover, upshore, doing that in the gig economy space too. So we're seeing a real shift towards that, undoubtedly.
And what is the main benefit premium benefits? I would have thought from an economics point of view, if you're smaller than a larger player, economics tells me that you can't price at the same level as they can. So I'm a bit confused about how you actually save money by self-insuring.
Yeah, absolutely. So if you take somebody like Allianz, or a big insurer, that they've got significant global risk that's spread across multiple industries that's getting impacted right now. So, they're having a really tough time in trying to, insure risks through Europe, UK, US, Pacific, that sort of thing, as well as their, a listed entity that's trying to deliver return on investment for shareholders. we're talking about here is niche. It's smaller. The risk is contained. It's a clean slate risk because we're building it from the ground up. So we don't have the same legacy issues or global impact issues that we're trying to deal with. And then when we do buy insurance, because we're pooling a set risk or a really easy to understand risk, we are buying reinsurance, but we're buying it at a much higher level. So rather than having to buy it ground up, where we might be getting it at significant excess layers, which makes the insurance purchase cheaper for us. So
I got it. So you're not paying for everyone else's risk. It's a specialized product just for and it's probably easier 100%. To actually risk rate too, because it's captive and it's specific.
Exactly right. Spot on. And there are some tax advantages as well. So, if you look at what our ARC are doing in that discretionary mutual fund space in far north Queensland with the Anglican Diocese, discretionary mutual funds don't incur statutory charges. So they're not paying stamp duty and all that sort of stuff on premiums, fire services levy, any of that sort of stuff. So when you take statutory charges off the insurance premiums as well, there's an immediate saving or immediate benefit there too. So there are some tax advantages as well as risk advantages to that.
Yeah. Okay. Got you. Thanks.
Gemmo.
Hello, yes, Cam. Good question. Sorry, Chris.
You're all right. Sorry, how you going, Gemmo? It's been a while.
I'm wonderful. Yeah, it's good to see you.
Yeah. Just a quick question with the mutuals. I never quite got the understanding of it. Just sort of further to Cam's question. Do they have the rebates at the end of the premium year? Is it like what we used to do with the trust funds? And sorry for everyone else in the room, but I used to work with Gemmo. So is it very similar to the way that it was organised there, where at the end of the insurance period, what was left in the trust fund was then shared back amongst the group?
Yeah, so there are multiple ways you can set this up. Under the discretionary trust, that you can do that. Under a discretionary mutual fund, it works a little differently, where any surplus in the fund does have to get returned to members, but it doesn't get returned to members as cash. So it can get returned to members as reductions in their next year's premium. It can get returned to members in risk management initiatives, supporting better. It might be an investment in better risk management or on-site assessments, whatever it might be, that's going to ultimately improve the risk of the membership base, is how surplus funds get reinvested. And we've seen another reason we've seen a bit of a push in this is in 2019, the Corporations Act was changed to introduce mutual capital instruments, or MCIs as they're referred to, which basically means a discretionary mutual fund can go and acquire capital in exchange for an MCI. And Australian Unity did one. I think it might have been at the beginning of this year. They did the first on-market MCI cap raise. So it's really attractive for this model now, because it means that the mutual environment's not set up to acquire debt as a sustainable way of raising capital. So to be able to go and issue MCIs as a cap raise is really, really critical. So effectively, what you're trying to do is build up capital in the fund, do that through an MCI raise, pay off those investors, get the fund to stand on its own 2 feet, and then if there are still surplus funds in that, then reinvest it into initiatives or reductions in premiums. Does that make sense? Does that answer the question?
Good question, Chris. Does that answer your question, Chris? Too many Chris's. But we've probably got.
Thanks, Gemmo. That's awesome.
We've probably got time for 1 or 2 more questions. So is there any more sort of burning platform issues from the floor in that space, or anything else anyone wants to throw out there in terms of commentary or queries?
I got a question for Chris. It's a little bit specific, but I'm happy to put you in touch with the person that was asking me this question, or arrange another meeting with you. I've got a peak body in Queensland, and they're an advocacy role for kids in foster care and youth justice and things like that. So Anglicare and Uniting are part of this group through to like the small providers. And when the Royal Commission in Child and Sexual Abuse came out, a lot of the insurers pulled out and stopped insuring these guys. these guys have got government contracts to deliver the services, and they can't operate without that insurance. So the type of insurance I understand is the professional standards insurance. So I was just wondering, is there any, do you know anything that can help, these guys or something?
Yeah, definitely. This is an issue that we've been facing ever since the Royal Commission. So that market that you're talking about there is incredibly challenging, as you can imagine, even to the extent that even property insurers are struggling to write property in that industry. So, we've seen a insurer appetite to write anything in health and community services completely evaporate. But there are still particular insurers that if you go to the right people in the right place and you get them in the right mood, that will write that sort of thing. So parts of it are a little bit grim, so I won't sort of go into too much detail in this room about what that insurance looks like and what people do need cover for, as you can imagine. So maybe let's catch up after and we can go through sort of what you can and can't get and who some of those markets are to be able to approach.
Yep. That's what I was hoping you'd say.
Perfect.
Thanks, Dave. Good question. Any others that are sort of burning? We've still got another minute or two if someone's got something they've got rattling around their mind. Remember, it is Chatham House rules here, so what's said in the room stays in the room.
I've got another one, but I don't want to take up the space, so I'll open it up to the floor first.
I just wanted to say that I wouldn't mind catching up with Chris offline about that question related to captive insurance companies. I think there's someone I could probably introduce you to that I'm working with.
Yeah, happy to. No, I'd love to.
Cool.
Thanks, Cameron. Brian, you're barred from asking questions after the supply chain one.
I was wondering if you were going to say that. But I have got another one, but I won't ask it. It's okay.
No, go for it. I'm only joking.
Okay, so it related to that sort of management or executive team liability type of insurance. And if you've got any updates or insights in relation to that, we've seen some changes in the WHS space in that regard. But anything else in terms of management and executive liability? Absolutely.
So directors and officers liability has probably been one of the hardest hits, and it was certainly the first market really badly hit in this in the hardening insurance market. So that was predominantly driven at the time by listed company class actions. So that pushed the market up. And I think in 2019, and don't quote me on these figures, but the market, the directors and officers market had something along the lines of $350 million in gross written premiums and $1.4 billion in claims in Australia. The biggest underwriter of D&O was Allianz Global. They completely pulled out of the market. So Allianz don't operate their Allianz Global business in the region anymore. So we saw huge claims driven by class action and a significant reduction in capacity. So getting D&O insurance remains really difficult, particularly for listed companies, and it is challenging. And we've seen, it's not uncommon in that market to see 200% and 300% increases in premium and significant reductions in insurance limits. If for unlisted companies, it can be easier if you've got a good relationship with your broker and they do sell your risk well into the market, but do expect pricing challenges in that D&O space. That the D&O is D&O and cyber undoubtedly driving significant increases in that financial and professional line space that I spoke about earlier, both here locally and globally. But again, it's all about selling risk, and the bulk of people here, if not everybody, will be talking about unlisted companies. So there are good deals out there for you in that world, but it's challenging.
Okay, thank you. I just knew that there'd been a fair bit of movement in that space, so thank you. And that's it for me for questions.
Right. Well, look, unless there's any final comments or queries, I'll wrap us up there. And look, Chris, that was fascinating, and I think a couple of things I just wanted to summarise for everybody. I guess, look, for us that business owners ourselves, it seems like the time has never been, it's never been a more important time to get in early with the way that we, I guess, engage with our brokers and gain our insurance. And obviously this concept of really selling our risk well in the market. I like that, Chris. It really sort of resonated with me. But then obviously also it seems to emphasize more than ever, one, if you want to even get near getting cover, you've got to have really quality internal frameworks and systems to actually manage risk, which is, that's good to hear, because I think that's something Bronwyn and I have been banging on about for the better part of a decade. I guess some of the rest of the world is starting to listen. And then look, particularly, I'd love to really, I could definitely sit down with you and chat. I'm really fascinated by these alternate insurance models or vessels or whatever you want to call them, particularly for some of our clients. And I was thinking David Hubbard and our sort of shared collective clients in that disability, aged care, community services space. I'm kind of just feeling as though that's going to become a really important thing for a lot of entities in that space in the future. And no doubt, poor old long suffering coal mining as well may need to be looking at all sorts of alternate models to even get itself cover.
Interesting to see if they do move to that self-insurance model that, that they've been talking about. So watch this space on that one, I'd say.
Yeah, agree.
Yeah. So look, really appreciate everyone's time. Hope you got a lot out of it. We'll send out the recording and the slide deck later today. And we look forward to joining you guys again, or whoever's available, same bat time, same bat channel next month. We've got a couple more to go for the year, and they'll be fun and exciting, and they might even involve Bronwyn wearing funny hats. So,
or not.
Yeah.
Do I look like a funny hat person?
I'll keep trying. So, yeah. All right. Well, look, thank you very much, everyone. Hope you have a great rest of your afternoon. Thanks again, Chris. Really appreciate your presentation. It was fantastic.
Yeah. Thanks, guys. Thank you, Chris.
Thanks,
Good to see everyone. Take care.
Bye.